Welcome back to another episode of the Investors Row podcast. My name is Ramesh Fakori, your host, VP, and one of the managing partners here at the IRA Club, and we're always happy to have you. I know there's nowhere else in the world you'd rather be than just to hang out with me and learn something new about alternative assets. Now, we're no strangers here. If you heard me speak in the past, we talk a lot about real estate. Real estate is being part of your options inside of your retirement portfolios. And yes, you can invest a portion of your retirement dollars in real estate deals. But in particular, we're going to talk about a different niche, right? They're all niches, but at the end of the day, this one's very specific because I just kind of want to nit it in the butt. There is a serious problem with affordability in the United States. We've talked about that in the past. We're probably 5 to 6-7 million underbuilt, and we have to think about ways to help, right, our fellow Americans and how to invest in such things like mobile homes or mobile home parks. And today I have a special guest, Brad Johnson, who actually specializes in this. He is the CIO, please forgive me, Brad, and the co-founder of Vintage Capital, who's part of our Investors Row program. And we talk a lot about how this strategy, diversifying a portion of your retirement dollars, can be useful inside of your IRA or 401k. Without further ado, Brad, it's always a pleasure having you, good sir. Tell us a little bit about Vintage Capital, how it came about. Talk about yourself. What am I talking about? I hate talking about individuals because
no
it's not doing justice. So you knock it out. I'm here.
No, well, thanks for having me on today, Ramez. It's always nice to chat. Yeah, just maybe a quick background. My story in real estate started, I don't know, call it 20 years ago. Started buying individual single-family homes because I couldn't really, I just didn't trust the business that I was in. I was building a small consultancy business, and I was worried about the future of our business. And so I would take excess cash that we made from the business, and I would put it into these retail these residential single-family home rentals. And they were in markets that I thought was really cool to go visit as a 20-year-old. And I did that with a buddy, and I just kind of fell in love with the asset class. I just, understood it. Really liked putting in money to capital to new properties to fix them up. And then, I spent some time on the institutional side of real estate, working for a big Wall Street bank, working for private equity, played in a bunch of different food groups, and realized that I wanted to find something niche-y that I thought the downside was protected, because I had seen, investing in these individual one-off deals all over the country is great, but you only had one tenant in the home. And if you got a bad tenant, right, all of a sudden, you were 3-6 months into no rent. And so I wanted something much larger that was diversified and had a lower risk profile than just straight off rentals. And so I got into manufactured home communities, aka mobile home parks, and started buying those in 2014. Got up to 2,300 pads and then couldn't make sense of the pricing anymore around COVID. So sold that portfolio and kind of waited on the sidelines, started making limited partner investments, started partnering with other groups, and have really been ramping back up now that the pricing makes sense again. I think the future is bright for affordable housing. For the foreseeable future, you kind of touched on the fact that it's a crisis, and that is 100% correct. So yeah, we can dive into any aspect of the niche, but that's a quick overview.
I'm going to tell you something. You said to me one time, because I've had you on before, a couple webinars and vice versa, and I've seen you at a bunch of events, and I've heard you speak on your own podcast, by the way, which I want you to give a shout out later to. But you once compared mobile home parks pricing power to Netflix and Disney. I died when I heard that. Why that statement? Like, break that down for me one time.
Well, I remember when my kids were kind of 5, 6, 7, right? We had a Disney season pass, and we went way too much. Like when I was a kid, it was like this whole big event when we go to Disneyland. It was like once a year, and I was thrilled. I couldn't even sleep the day before. And my kids got to the point where it was like, oh, we're going to Disneyland again. And I'm just like, so A, I had to stop that. But B, these passes that we were paying for, every year we'd get these 25%, these 16% increases. And we didn't blink. We just, sure, take our money. And the same thing for Disney Plus. It's like, okay, this is high quality entertainment that's giving a lot of value to my family and especially my kids. And so we just kept paying. And the same with Netflix, right? There's no sensitivity. There's no elasticity, right? They're inelastic products. And housing is that way at the affordable side of the spectrum. You can, without gouging anybody, you can increase the lot rent because there's such a disparity between what we're offering as a housing option and apartments. And oftentimes it's $1,000 delta in between. So a $25, a $50 lot rent increase is not going to it's not going to cause somebody to move out of the property. So you do have pricing power in that regard if you use it responsibly.
Well, I want to just touch back on what you and I just talked about. There is a crisis, right? And there is a need for more affordable housing. Where do you feel that mobile homes, investing in mobile home parks is going to help bridge that gap? Like, why do you think, to your point, I think it's beautiful that you're doing something like this, but to our listeners, why? Like, why this specific asset?
Yeah, well, there's two things that are really helpful. One, when we add new lots, so we expand a park, that's extremely helpful to help solve the affordable housing crisis. Obviously, we're just making little dents, but we're doing what we can. As you said, there's millions of homes. It's probably, 4 to 5 million, who knows? I've seen numbers from 3 to 7. So anytime we can add a new affordable housing product and we can bring in a young family and kind of solve their housing needs, like that feels real good, right? The second area is improving existing properties that are falling apart, where the owner has owned it for 30 years. They have just been pulling cash out of it. They haven't had enough money to reinvest back into the roads, reinvest in the infrastructure, improve the quality of the homes, bring in new homes to fill vacant pads. So that is another big movement in our industry is leveling up the actual property management and the ownership of these assets. Because everybody's probably heard of the trailer park that you wouldn't want to drive through at night, right? The idea is that we are buying nicer communities that to begin with, and then we're putting capital into it, bringing professional property management systems, and really improving these communities.
I love that you said that, by the way, Brad, because there is this big misconception that, as a real estate investor, I don't want to deal with this asset class, like in mobile homes and mobile home parks, because there's this stigma that, they're just bad to deal with. You know this, and I know this, because I'm sure you've heard this a million times over. But you said there's got to be systems in place, right? And in order to hit a great ROI, you mentioned you're not looking into out of the ballpark mobile homes, right? You're looking to buy more so in C and B class neighborhoods and fixing them up. Correct me if I'm wrong.
Yeah, the thesis works just about anywhere in the country, right? There is overwhelming demand for affordable housing. The problem is just like the cliche in real estate, location still matters with mobile home park. It's just with mobile home parks, it matters less though. But you can't go out into the boonies. You can't go 2 hours outside of a reasonable metro area. And while you still might have the demand, you're not going to have the incomes to support, really any growth. So you want to be able to do it kind of on the edges of towns. It's rare that you buy something that is literally in the smack middle of a CBD or in the middle of a large city. Most of the time, those will end up being developed into something that's a different use, right? They'll go vertical. But on the edges of a town, right, kind of 20 to 30 minutes, sometimes even up to an hour if the metro is large enough, like a Raleigh or an Orange County, right? If it's a big metro area, you can go up to an hour, and you're going to get plenty of demand and plenty of people that kind of want to still stay connected to a larger city, a larger metro area, but want that space, want affordable housing, want to control their area, don't have three people above and on sides of them in an apartment. They want they want their own parking spot. They want some space. So you get plenty of people that are fine living on that edge, but you got to just be careful that the incomes of the area can support the lot rent that you need to achieve your business model.
I know that Vintage Capital, I know this just because of your company bio. You guys currently have over $100 million plus allocated in this asset class. What areas do you mostly concentrate when buying mobile home parks?
We're all over the map. We are not a lot. We don't have a lot of assets in the Northeast, and that is a function of partly just deal flow and partly regulatory. The regulatory environment there is fairly anti-landlord. So life's short. We just would rather work in the Southeast and pick our markets in the Midwest. We're selective in the Midwest. The Pacific Northwest also has regulatory issues. The nice thing is that it's kind of removed some of the doubt because people are like, well, are they going to implement rent control? Are they not? That's really hard as an investor to come into a market where you're not sure what the next couple of years are looking like. Moving forward, it feels better to invest in that market because they've kind of removed that doubt now. Obviously, you just have to factor in the maximum rent increases into your model. So that still works, but we like to, we don't like to completely restrict, like, hey, we're only going to focus on this one state because there's only maybe 10,000 of these assets that we would want to own in the entire country. It's not like apartments. It's very niche-y from that regard.
Well, so that actually, again, takes me to my next question. You talked about one of the hurdles when it comes to investing in mobile home parks. And this isn't like your traditional, forms of investing, like in your, a turnkey investment or commercial or mixed used or, multifamily. What are some of the hurdles that you see that are different, right, when it comes to investing in this type of asset classes that are not the same as your traditional forms of investing in real estate that I just mentioned?
One of the biggest hurdles is property management because you don't have 30 different groups to hire to manage your asset. So apartment buildings, you can kind of be an acquisition asset management specialist and outsource the day-to-day property management. Very hard to do in our space. You can if you have scale and you're buying really stabilized deals. If you're doing turnaround deals, there's not a lot of third-party property management groups that can pull that off because it's just a lot of heavy lifting. There are some property management groups in certain parts of the country that can babysit a stabilized asset, right? They're just doing the basics, right? Just making sure the place is, it's not catching on fire, it's not flooding, the rent's coming in, the notices are going out, right? But anytime you're implementing a business model or there's a little hair on it or there's big capital improvements that we do need to make, generally speaking, you would need to build out your own property management team. And that is not easy for people to do. So
not at all.
When we were at scale, when I was just an operator, not also partnering with groups, we had up to 30 people in our property management team. And, it's just a grind. Not a lot of people want to build out a property management company. The property management business I would argue, is not a very good business. It just enables the good side of the business, which is the asset management, the private equity side of the business. So that's a giant, probably the biggest hurdle for people to get over. Then there's some weird quirks just in how the regulations work for managing a mobile home park versus an apartment. And each state is different in that capacity. You're just kind of dealing with, a different tenant base too, of course, right? We have senior parks that are their own set of requirements and quirks. And then all age is the majority of our parks, which just means, kind of a younger family, maybe they have a few kids and they're just looking for space and an affordable product. So those are the major differences.
Let me ask you, does Vintage Capital manage all of your own assets?
No, we partner with,
you guys
we partner with regional groups. And part of that, it's twofold. One, it's the lessons learned when I was an operator and trying to, run a property management team from 2,000 miles away for some of our assets, not super efficient. And so we want regional focus. We want boots on the ground in that market, because the thesis is, hey, we own the land, we own the infrastructure, and the tenant owns the home on top of our land, right? That's the beautiful thesis. That's a great part of the business model. But there's this misconception that these things are just mailbox money, that because of that dynamic, you don't have to be in the weeds at the asset driving returns every day. That's exactly the case. You have to drive operational alpha in our space. You can't just like sit back and watch the money come in. So we want to partner with groups that are local. And so the second reason why is that it increases our view of deal flow. So we get to see deal flow from 15 different partners now, whereas when we were just the sole operator, we only got our own deal flow. So it really does help us spread out and diversify and see a lot more deals when we do it this way, versus, we have some operators that only do one deal a year. And, that's just not enough for what we're trying to accomplish.
I agree with you. The only reason why there's a third part to our third component to that, and the reasons why I was bringing it up is I know we have mutual clients. And one of the questions that we sometimes get here at the IRA Club is, I was told that if I'm investing my IRA dollars or 401k dollars into a mobile home or mobile home park, I was told that I cannot manage the property or step foot into the mobile home. And they're 100% right that you cannot do that. It's actually considered to be a prohibited transaction. In this case, what we try to explain to the client is, you are investing your retirement dollars in a fund with Vintage Capital, and they're deploying the dollars, right? And it's managed through the property management companies. So your IRA is still at arm's length. You are not dealing with the day-to-day operations. So with that, let's just jump right into it, Brad. Talk to me about your current investment opportunities. Educate us on what you got currently going on.
Yeah, so we typically do both funds and individual deals. So the fund, nice. I think, is actually appropriate for most investors, because unless you have hundreds of thousands of dollars where you're going to split up and make your own little portfolio, selecting deal by deal, the fund is a way to get immediate diversification. And it's very hard to break a fund. You almost have to actively over leverage or do some really goofy things, because you're diversifying by market, you're diversifying by the business model for that particular deal, right? So some are stabilized, some are value add, some are opportunistic. And we actually are diversifying by the property management groups on each of these markets. So it is a very highly diversified type of investment, which tends to be more appropriate for, I would argue, people who are focusing on retiring, people who maybe don't have millions to put into private markets. Whereas when you're investing deal by deal, like, you need to have some judgment about what you're looking at. Do you have the capacity to evaluate? And plenty of people do. Plenty of people do, of course. But I like to make that caveat, because really, I think a lot of people who invested in the apartment world and invested in a couple of deals this last cycle might have gotten a little over their skis because they just didn't have enough diversification. And they didn't realize that, I'm investing in these floating rate loans, and what are the downsides, right, of doing that if interest rates spike 400, 500 basis points, as we saw. Anyways, we handle both, both individual deals and funds. The people that invest in the individual deals, a lot of them are ex-real estate players that have semi-retired or looking to generate some passive income and depreciation benefits, because maybe they're winding down their own real estate career.
And if you don't mind me asking, what is the people that are individually investing with you, what are the typical minimums that you're seeing?
So we'll
are
go
they
down
just
to...
Are they partnering on your deal? Is that what they're doing versus the fund itself?
Yeah, so we're doing SPVs into an individual deal, and the fund comes in and invests alongside. So it gives people kind of a two-way street to participate. And some investors, a lot of people will just invest in the fund as the initial investment. And then once they see a deal they really like, then they will add on to the individual deal. That's kind of the main way into the Vintage Capital.
So that's what you see is like the pattern of like somebody jumping in, they get into the fund first, they like what they see, and they kind of execute a bigger transaction with you.
Yeah, they get some baseline depreciation. Yeah, they get some good depreciation, and maybe they want to bump that up because the individual deals will have higher depreciation, right, per dollar invested. because we're not spreading it out, and it's into one deal versus a fund that's been raised over a year and a half. So it's 2 tax years, right? So yeah, we most investors invest 100,000 to 250, but we do have people that come in at 50 just to kind of get some exposure.
And I know, Brad, why you do that for IRA Club clients, right? Because most Americans, believe it or not, do not have, the average actually is about 50,000. So, and you're well aware of that. I think your whole team is well aware of that. And we thank you at the IRA Club because our job is to educate. And you talked a lot about diversification, and that's what the beauty of your fund is because that's one of the things I always talk about is diversifying one's portfolio. You actually take it a whole step further, and it's a better job of allocating those risks that you talked about, right? God knows if there's another COVID in the horizon, or God knows what Mr. Trump might say tomorrow. So those are great avenues that I always tell people to look at. I always preach, Brad, and always tell investors, especially when you're utilizing retirement dollars to invest in these alternative assets, always do due diligence. So what type of due diligence do you educate your investor base when it comes to investing in your deal? There's always risks to anything you do. So what do you tell people what can be some of those risks is what I'm trying to get at.
Yeah, well, with mobile home parks specifically, you're kind of looking at, there's really, I would say, 3 major risks. There are, well, let's go with 4. Let's go for it. Okay, so the first one is infrastructure risk.
Okay.
That is, okay, these things were built 30, 40 years ago, many of them. So your pipes and your roads, right, you can have surprises with your infrastructure and your utilities because that's what you're providing to the community. You're providing a pad, right, a piece of land that they can put their home on, and then they can attach to the utilities. So it's almost like an infrastructure type of investment. The nice thing about infrastructure risk is generally we can bracket it. Like we're not going to have a $10 million problem, right? It's going to be usually a 50,000 to maybe a couple 100,000 is generally the range of most of the problems that we see. I would much rather take infrastructure risk than say number 2, which would be demand risk. Like with an apartment, you might have a new apartment that opens across the street, brand new product, maybe built in the better part of the cycle, so they don't have it can lower rents versus when you purchase the asset. Maybe you're in a market where the incomes are a little soft, and maybe a major employer is leaving town. So I think of that as demand risk. I almost never want to take demand risk. Number 3 is weather risk, right? I think most people in real estate are seeing this firsthand in terms of their insurance premiums spiking due to just the fires in California, the floods and hurricane in Florida.
Hurricanes in Florida.
Yeah, everybody is feeling the pain of increased premiums, and mobile home parks are certainly susceptible to major weather events, which is another reason why I like people diversifying into multiple assets within the space. It's highly unlikely. Like most of these things, if you look at the historical satellite images, which I like to nerd out and do, of these properties, you can kind of go back 30 years and you could see the occupancy and see if there's been any changes in homes moving. And look, all these parks, 98% of them, no problems from a weather standpoint, but it can happen. And then what was my last one? Oh, my last one was operator risk.
The 4th. You said there was a 4th.
Yeah, the 4th is just operator risk. So generally you want to focus on a sponsor that has a real track record. I love investing with emerging sponsors just as a limited partner myself because, but I'm a pro and I can at least evaluate the real estate really well, and I can help them out if things are going sideways. We have resources to do that. So when you're first starting out, and you're a retiree or you're thinking about your retirement, it's your first check, I probably wouldn't be going with an emerging manager. I probably would focus with somebody that's been doing this for a while, that's seen problems, that's learned a lot of mistakes. You want them to make mistakes with their own dollars or somebody else's dollars 10 years ago, ideally, than with your assets. You don't want them learning on your dime. So anyways, that's my 4 takeaways for kind of evaluating risk.
I actually like the fourth one. It's rare that one thing I always like about you, Brad, is you're brutally honest. You're going to say it how it is. And the fourth one actually nobody would ever consider, right? Is an operator who's just not doing a good job. I always like saying you're paying tuition, right? To learn, but not at the expense of the investors. Do it with your own money, be an expert, and then allocate those dollars in the right way. So kudos for you, and that's why I do appreciate you when you talk about having the right operators in play to manage these investments. But listen, if somebody just wants to learn more about Vintage Capital, how can they find you?
Vintage-funds.com. We have a ton of resources on educating people in the space. We want to see new sponsors in the space too. We want to see people go out there and make these investments. We hope to partner with you someday. I'm a big believer in that this asset class needs to level up from an asset management, property management standpoint in order to help with this affordable housing crisis we've touched on today. And so the more that people understand about this space, the better. We have a growth mindset. Like whether or not you invest with us or not, that's fine. We'll be just fine. But I want people to really understand how it works and understand the benefits of the asset class.
And talking about how it works, don't be bashful, don't be shy. I know you have your own podcast. What's the name of your podcast so people jump on and listen?
It's called The Alternative Investor. So we talk about probably a lot of things that you talk about. Yeah, a lot of things that you talk about in terms of private markets and niche investments, things outside of the stock market.
Yeah, and we always talk about things that are currently happening. And in particular, what we focus on a lot, as you well know, Brad, is retirement. And retirement for not just now, but your future and your legacy beyond that, and how to pass that along, and tax savings and whatnot. But I highly recommend, if anybody's listening, take a listen to that podcast. I've learned a lot of things, Brad, driving in the car and just popping that on or downloading it. So thank you for everything that you do, because I'm big on education myself, because at the end of the day, as all my listeners know, the reasons why I host these podcasts is I cannot choose the investment for the investor. That is the reasons why I always bring in resident experts like Brad to talk about these types of strategies, especially something like this, all right? And if you want to learn more just about Vintage Capital, feel free to visit IRAclub.com. Go to Investors Row. That is our marketplace. Vintage Capital is there, where you could learn about their current fund minimums. And one of the things, actually, Brad, that I forgot to mention about your fund, is it only open to accredited investors, or you do allow non-accredited investors to jump on your investment?
At this time it's only accredited. Yeah.
So, but in the future, is there a possibility for a non-accredited investment option?
I hope so. I do think that we are going that way. The administration, the SEC, there are a bunch of proposals that are loosening the requirements. There's ways around it. You can pass the Series 65, right? So there are inroads, but I do think in the future there will be options for non-accredited. I mean, you see 401ks now, they just approved alternative assets into 401ks. So it just feels like momentum is heading that way, which is why it's so great what you guys are doing, right? I think that private assets mixed in with stocks and bonds couldn't be more appropriate for retirement accounts. And we're going to be living a lot longer, I think, than prior generations. Yes. And people are going to have to figure out ways to generate income and reliable returns with lower volatility than just kind of riding the stock market. So I really applaud what you guys are doing.
Thank you. And I do thank Mr. Trump for opening up an executive order that allows for that. And that's our specialty. That's our niche. That's what we do, is alternative assets. Not that I've said this before in the past, not that we have an issue with the stock market. We actually offer that to all of our clients. The name of the game, as Brad and myself always talk about, is diversifying one's portfolio. And we're super stoked for the future and people's retirement accounts, because, as Brad said, we are living a lot longer, and we need to find ways to create double-digit returns. That's just a fact, okay? Cost of living is only going in one direction, all right? And COVID just happened to accelerate that for us. So thank you to COVID. But with that being said, We'll love to have you or join you on our next podcast. Please visit us at iraclub.com/podcast, or just visit our website, iraclub.com. And feel free to visit our resource center, and there's a lot of great educational material on there, like blogs, upcoming events, and anything else that we could do to help you succeed in your retirement account. Brad, I want to give you final thoughts before we fade into black.
No, I think you nailed it. I think we covered it. Thanks for everybody joining today. If you want to, like I said, learn more about Vintage Capital or mobile home park investing, go to vintage-funds.com. Thanks for having me on, Ramez. It's always a pleasure.
Brad, thank you, sir. It's always a pleasure, buddy.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.